Hey everybody, welcome to Wow Wednesday, Words of Wisdom Wednesday from the Davis team here at Cross Country Mortgage. We're going to talk today a little bit about debt to income, or DTI. More so about why it's important and why it really plays a factor into what you qualify for. Debt to income broken down is just simple. What is your debt in relation to your income? We want to make sure that there's different levels depending on different products, what we can do for our debt to income. VA loans for veterans, they really don't have a debt to income. They're not really run by credit or debt to income. It's just kind of the overall residual income. So I kind of probably get away from the VA aspect of this process. But real quick, we can get VA loans up with debt to income, even up in the 60s, depending on other factors. General rule of thumb is conventional loans, we want to see them under 50% debt to income. And we use your gross income. And for debt to income calculations, we're only using what's on your credit report. And there are three things on your credit report. It's installment debt, like car payments, bank loans, student loans, things like that. Mortgage debt, which is obviously a mortgage, to include home equity lines of credit. And also revolving debt. Revolving debt is any credit cards, store credits, Amazon, Best Buy, things like that. Um, Anytime you have an installment debt that's being paid off within 10 months, we don't count that payment at all against you. And we're only counting the minimum required payment. So if you have a credit card payment that the minimum payment is $25, but you are very good managing your money, so you pay it off every month, or you pay $100 a month extra, the only thing we're counting in your debt to income is that minimum required payment. And it's your gross income. So if you make $5,000 a month, you bring home $3,000 a month, we're using that 5,000 versus the 3,000. So it gets kind of confusing when folks try and figure out what they qualify for on their own based on debt to income. So it's important to know those numbers, the gross numbers, the net numbers, they're all a factor into the conversations that we have, but the qualifying number is based on your gross income. Conventional loans, we want to see them, like I said, under 50. FHA, we want to be under 56, kind of in that range. Jumbo loans, which in our area is anything over $822,375, and that's loan amount, not sales price. You could have a loan amount, you could have a sales price of 10 million. You just got to put down enough to make sure your loan is 822,375. But anything greater than that number is considered a jumbo loan in our area here in Washington D.C. And we typically want to see those debt to income ratios at 43% or lower. And there are some niche programs where the debt to income required is even lower than that, but they have amazing rates, low down payments, but very restrictive on credit scores, your debt to income, and tenure at your job, or even how you're paid in some cases. A lot of folks make $10,000 a month. That's what they put on their application. Once we peel the layers away, they make that $10,000, which is awesome, but $9,000 of it is commissions, and you just started a job last month. We can't use that. Or if they're part-time income, they have two jobs, there's different requirements, so people get kind of tied up in what they actually make. So the actual debt to income number is very important to the process, and it has to be very accurate. So best advice is to call a lender that you trust, Scott Davis, the Davis team, 703-209-3138, and we can go through all of your debt to income, all of your liabilities, and any that we have to count or we can't count. And we'll go through the whys and why nots of this whole process. So please like and subscribe on the YouTube channel. We want to customize this channel, so we need to get to 100 subscribers. If you have any questions, again, give us a call, but have a fantastic Wednesday and see you next week, guys.